Hey, welcome back. I'm glad you're here with us today. Listen, here's what I want to do. Just recently, I did a kind of a state of the market, a snapshot of the market right now, spring 2021 for the commercial investment market. And I want to give that to you guys today because we're at an interesting time. My name is Mark Hulsey. I'm the managing broker of Results Commercial. We're a commercial investment firm in Minneapolis, St. Paul, Minnesota. So we are commercial investment brokers and we work a lot on the investment side, you guys. But let's talk a little bit about this. Here's the interesting timing. It's 1 year later. Okay, we're 1 year later right now. Pandemic basically came into effect about 12 months ago. And so now here we are, many of us were pontificating on where's all this going to go and what's it going to mean for commercial real estate. And listen, you guys, it's still unfolding. All right, I was just reading a couple articles last night from Bloomberg talking about, the many billions of dollars that we're going to see going into default. Okay, and they're really talking a lot about hotels and some very large retail, some of those trophy things. That's what I'm going to talk with you guys about today. All right, I'm going to kind of give us a really quick product category by product category. I'm going to go right down the list and kind of let you know what we're seeing. We're very active brokers in the marketplace and we're seller brokers, okay? We take product to market. That's what we do. So I want to tell you where we're at right now and kind of see where we're going. So we all know that this lockdown has had a devastating effect on many, many companies, on many businesses. This has had just a killer effect. Obviously, bars and restaurants and all kinds of other types of goods. Now, you've got on one hand, you've got sporting goods, you've got grocery chains, you've got some of these businesses that are doing wonderfully well during the pandemic. But then we've got some other ones that have taken quite a hit, as those that I just mentioned that are most affected by the lockdown. It's interesting because we get a lot of people saying to us, hey, where's all the inventory? When's the inventory coming? With businesses going out of business and bars and restaurants suffering and all of this, we would expect this big influx of commercial investment inventory, right? Because inventory is the big deal right now, both on the residential side as well as the commercial investment side. Here's what we see. We do a lot of bank work, okay? So banks are clients of ours, and we take their assets to market to dispose of those assets for them as REO, real estate owned, foreclosed properties. Banks have been able to be in a position over last year, 2020, all the way through into 2021 to say, we are not doing any kind of a rapid foreclosure with distressed properties going into a default state. Forbearance, simply, we will work with you on your debt payments, on your mortgage payments. We are not going to come in and do a typical foreclosure as we normally would. And so many buyers are saying, well, I'm going to wait until all this inventory comes in with all these new bank properties that are going to be coming to market, just like it did during the Great Recession. We're still not seeing that. In fact, I don't know that we're going to ever see it with the pandemic effect here as we did with the Great Recession. Okay, so that's kind of step number one. Yes, we are going to see distressed assets coming into the market, and we expect them to be a lot of trophy assets, and yes, there will be a trickle down to some of the other assets that are going to fall in the small commercial investment range, which is the $1 to $5 million range. But that's one of the interesting aspects of the conditions today, you guys. Here's the other part. This isn't just about the pandemic. So as I mentioned to you, we are based in Minneapolis, St. Paul, Minnesota. We are ground zero for the social unrest, right? This is where it all came down with George Floyd. This is the place right here. Just a horrific situation that is now spread across the country and actually spread across the world. This has had a profound effect upon the marketplace. Okay, I'm not exaggerating this. We've got about a dozen cities throughout the U.S. that have taken quite the hit because of social unrest. So it's a two-pronged problem we've got here, right? We've got pandemic, we have social unrest. Now this social unrest, what's happening? It means that people are really saying, I don't know where this is going. Here we happen to be dealing with a trial coming up, and so people are saying until that trial is done, I'm not so sure about going back into the central business district or certain neighborhoods. We want to see what happens here. Just yesterday or the day before, in our Twin Cities, we have Target stores, General Mills, 3M. We've got some major corporations. They were set to go back into the central business district and move back into their offices coming up in June. They have now said, we're waiting. We're going to wait until September. Do you know what that means when you have a major corporation saying, we're putting this off for another 3 or 4 months? All the restaurants, all those businesses that are located in the central business district, they count on those corporate workers to eat their lunch, do their entertainment. There's just so much commerce that's based around this. And now we have that being put off for many more months. Us as brokers, where do I feel this? When we take and we list a nice retail building or a commercial office building in a downtown. In fact, I'm in downtown St. Paul right now. I'm in a beautiful building called the Wakota building. We're happen to be leasing this building for the ownership. And Hayden's going to tell you about that in just a little bit. But here too, this central business district is taking a hit. It's taking a hit because of pandemic, because of social unrest. The third one, okay, there's 3 of them. It was the election. Every election year when it comes to commercial investment, people are always saying, I kind of want to see what's going to shake out with this election cycle before I start making too many decisions. Thankfully, we're through that. So thank goodness we're through the election at this point. Now we're getting a little bit more stabilized with our administration and our Senate and our Congress, et cetera. That's a good thing. But now we need to work through the vaccine, we need to work through the social unrest, and we need to get back into a more stabilized market. Now, here's what I want to do. I want to hit these categories, you guys. All right, let's start at the top. What's the hottest category? This, by the way, this isn't just reflective of Minneapolis, St. Paul, our Minneapolis marketplace. This is really what I'm going to be talking to you. I think you're going to find these trends across the country. Industrial. Industrial is it, man. It's the hot one. Industrial assets right now. Manufacturing, distribution is really driving the industrial property market. There are a lot of entrepreneurs out there, engineers and innovators who need space to roll out their new ideas. They want to get out from a small office space, a small industrial space. They want to move up. Get out of the basement, get out of the garage, get out of the workshop, and they're ready for their next space to go grow. Tough to find it. In fact, even our rates on many industrial properties have gone up significantly right now when it comes to both the leasing or the purchase of industrial properties. So we recently listed an industrial net lease asset, a triple net industrial asset. And I'll tell you what, guys, it rarely does it happen where in our commercial investment world where I get 5 offers in a week and 2 of those offers were all cash. And this was on a $2 million asset. And so I'm talking gangbusters when it comes to certainly industrial net lease assets, but the industrial category is a very hot category. Multifamily, that's number 2 on the list, okay? Multifamily, still hot. It is. But what part is hot? That's what's so interesting here, you know? Here's what I mean by that, right? Multifamily is a big category. You've got residential multifamily, 2 to 4 units, and then you've got small commercial, 5, 10, 20 unit buildings. That's small commercial apartment buildings. And then we start moving up into the 50 units and 100 units, and then we get into our trophy assets, okay? Trophy portfolios. In fact, we just listed a portfolio of 37 units, and we were able to get that $7.5 million portfolio under contract in a very short amount of time by an out-of-state buyer who's growing their presence here. And it was a mix of mainly multifamily with some additional commercial. Here's what's interesting. I read the statistic that said in Minneapolis marketplace, in our Twin Cities last year, multifamily was down 46%. Now, if you're a buyer and you're looking for a 5 or 10 or 20 or 30 unit building, I don't care, $1 million, $2 million, and you want to go find that inventory right now, good luck. Good luck, right? It's still that tight. And we're still dealing with what we call cap rate compression. And that just simply means that, geez, when we got a hot category like industrial net lease or multifamily, you're not seeing cap rates of 8 or 7.5 or 7 or maybe even 6.5. And suddenly cap rate compression can start bringing things down to 5.5, 5, 4.75. That's cap rate compression. A smaller return on investment because investors say, I want that. And they chase it and it brings down the return. So that's how that works. So let me go back to what I just mentioned to you. 46% reduction in overall sales volume in our marketplace in 2020, but yet I just told you, you can't find small multifamily apartment buildings. What does it mean? It means that the big stuff, the trophy assets, as we went through pandemic, as we went through our social unrest, as we're going through this situation of tremendous uncertainty, Some of the big dogs, right, from the REITs to the big institutional buyers said, we're going to hold tight for a minute. We really need to play it safe here. We want to see what's going to happen with this marketplace. And hence, we had a reduction on some of the much larger multifamily assets trading. Retail. Okay, everybody hears about retail, right? Because we'll all hear that, you know what? Retail? Well, Amazon's got the whole retail market. Who does retail anymore? And that's a bunch of baloney. You got to look at the statistics. Yes, obviously, we've watched a huge ramp up with online sales. If you take a look at our holiday season in 2020, I mean, you're talking about stores like Target had a 100% increase on their online sales year over year. I mean, these are staggering numbers. But when you look at the whole of it, the all of it, and you start to say, the average consumer, are they doing 100% of their shopping online? Of course, the answer is no. They're not doing that. It still is actually just a fraction of the overall shopping happens on an online environment. But retail is a changing sector. It's a disrupted sector, and online is having an impact upon that. Lockdown is having an impact. When you're starting to shut those stores up and you can't get to the bicycle shop and you can't get to the shoe store and these small retail businesses, it has a very profound negative effect upon those companies. Many times margins are not that big to keep supporting a long-term lockdown, and hence rents can't be paid, and we're in a really dire situation. So retail is a category that we're watching closely. There's plenty of opportunity, but once again, like almost all assets, what are we looking for? Location. Okay, key locations are still going to win in these situations when we get into these tough markets. Office. So there's the big one, right? This is the one that everybody's all abuzz about, is the office market. Well, my goodness, office must be dead because no one's going to offices anymore. They haven't gone to offices since last March and April. And now everybody just works at home, right? Well, not everybody, because that's not the way it is. Some of us entrepreneurs still actually go into an office. But as I mentioned earlier, we do have major corporations that are shifting and changing completely the way they do their work environments, their office environments. This is very fluid right now, you guys. Okay, so it's everything from going, hang on, some of those big open workspaces, we need to go to private offices. Hang on, some of those cubes, we need to go to an open collaborative workspace because we're going to have a hybrid working situation. We need privacy, we need shared space. Some people are going to come into the office 2 days a week. Some might come in 1 day a week. My point here, you guys, is that there's a lot going on. I mean, just think about the shared work environment, right? Shared work environments was just going nuts pre-pandemic. I mean, my goodness, just look at some of the major companies that were playing in that space, and look what's happened ever since now. We need to deal with social distancing, right? People staying home. Suddenly that shared workspace idea has changed itself completely. So, office isn't dead. It's just evolving. There will be a net fallout from office. But guys, it's not going away because we all want to, number one, a lot of people are getting sick and tired of working from home. They want to be around other people, right? We are social creatures. We want to be around other people. And collaborating makes progress. That's what happens. When we put our heads together and we put people together, great things happen. And companies know that. They know that suddenly you're fragmented, communication is breaking down. So we are not going to get away from the idea that people need to come together to have, progress with business, progress with commerce, and all the rest of it. Land is an interesting category, okay? I'm not going to get into land because, again, land varies from agriculture to timber to urban infill to residential development and commercial development. It's really all over the place, and that's the development side. We sell a lot of land, and we sell all of those lands, not so much the ag and the timber. We're much more focused on selling large parcels to home builders and also commercial developers, infill as well as suburban type land parcels. There's still a fair amount of activity going on with that, right? Builders realize there's still a pent-up demand. We are not saturated for housing in almost any market right now. But what has happened, many of the builders have said, we need to play it conservatively, we need to be careful. So they've kind of pulled back a little bit. Many of us have learned a lot of lessons still, and we're carrying them with us from the Great Recession. And that includes the builder market and the banks behind them. That's kind of the key thing, the lenders behind them saying, well, let's be conservative. Now we've got lumber prices that have just shot through the roof. We've got the tradespeople are all really busy. We're watching new home construction prices go up substantially. Very, very interesting marketplace, and it's going to be interesting to see where all this shapes out. All of these prices, you guys, they can only go up so much before suddenly numbers don't work. I don't care if it's rent being paid for a renter for their apartment. I don't care if it's rent being paid for an office user or a retail user. And I don't care if it's new construction lumber costs. At some point, we need to say numbers aren't working. Now, granted, because of low interest rates are really having this crazy effect on the marketplace. Just look at the residential market and low inventory and people chasing up prices $30,000, $40,000, $50,000 over market values. What do you think is going to happen when interest rates go up and the market starts to stabilize? Do you think some of those people might be a little bit upside down as they've just chased those prices up tens of thousands of dollars over a normal market? Of course they will. And once again, people will then say, I better live in this house for a little bit extra longer. And so those are the effects of interest rate. That's why many people are saying, you know what, maybe a bump in interest rates won't be so bad because we're going to start to create a more stabilized market of inventory for buyers and sellers. It's another subject I'm not going to get too deep into right now. Investments. Now, I alluded to a little bit with investments with multifamily earlier, you guys, when I talked about the 46% decrease on the big multifamily assets here in the Twin Cities. We do a fair amount of net lease investments, NNN, right? Net lease investments. I love net lease investments. They're just a fantastic investment vehicle. Very active. Okay, guys, this is still very, very active on the net lease side of things. But P&Ls and balance sheets for each of those tenants have been changing. Some of them going up, right? Some of them not going up. And so let's just say that suddenly you're the owner of I'll use a bicycle shop, okay? And they've got 3 different shops. They lease their retail space. They pay taxes, insurance, and all the operating costs. It's a true absolute, that's our word, absolute net lease. But when there's sales, and actually maybe bike shops isn't a good example because bikes have been flying off the racks like crazy, but maybe some other retail situations, those P&Ls have been really interesting over last year. And so suddenly those landlords on net leases, they're looking at that going, hang on, what's going on here? What kind of guarantees do I have? Suffice it to say, we've seen a little bit of changes on some of our cap rate expectations on some of our net lease categories, but it still is a very, very active marketplace with net lease investments. We don't see that changing for any time in the future. Small investments, absolutely. Are people very bullish on small office, small retail, BC locations? No, they're not. They're being very careful. Even on the multifamily side, where was the greatest pain? Some of the greatest pain wasn't just necessarily only on the trophy assets, but where was the pain for people not paying rents? Many of it came on some of the Class C type buildings. Not the Class A and the Class B, not the very nice buildings, super nice neighborhoods. Those landlords, they didn't suffer a lot of rent loss. But in some of the other more challenging areas and challenging neighborhoods, just like America, right? That's what's going on in America right now. It is the great divide between haves and have-nots. And it's really kind of a sad situation. Because on one hand, you've got just this robust flowing of money. On the other hand, we don't have, 2/3 of our population can't pay a $1,000 sudden bill coming into the home. It's a tough deal. Commercial real estate reflects that. It's a big world we work in. So listen, it's hard to do this in a matter of 10 minutes or so to give you this snapshot, but I wanted to give this to you right now, spring of 2021, 1 year after the start of our COVID pandemic, and where are things at today? Listen, we're here to help you, all right? And I mean, seriously, if you want to call, if you want to email, I took a call from a gal in Fresno, California yesterday, southern Minnesota the day before, and asking me questions about these types of investment questions. We've got a very vast network. We're happy to help you where we can. But check us out. And really, guys, I would love if you can subscribe to our channel because this helps us keep making this content for you, which I hope you're finding valuable. So go to Results in Real Estate, our YouTube channel. Please subscribe. Check us out on all of our social media platforms and our website. Our website's kind of the hub of everything, resultscommercial.com. Again, Mark Hulsey, I'm glad you joined me today, and I look forward to seeing you again.